Good morning, and welcome to the 14th Gulf Intelligence Global Energy Outlook Forum, with 20 sessions over 12 hours, bringing crystal ball forecasts for the year ahead by the top 50 energy market analysts from Shanghai to Houston. And the theme of our session this morning is Think Global, Act Local. So what we're going to discuss for the next 45 minutes is the increasing power of local regional economies on the global scene and the growing tendency of local energy corporates to position themselves as big players on that scene beyond their influence in the global oil markets, which we all know about. We've recently seen big corporate deals by Saudi Aramco in Asia, by ADNOC in the rest of the world, and these testify to the newfound global self-confidence of regional energy companies. So let me introduce Peter Zeilinger, Senior Vice President for the Middle East and Africa of OMV in Abu Dhabi, Kieran Gallagher, Managing Director of Vitol Bahrain, Robin Mills, the CEO of Kamar Energy, and welcoming back to the UAE, first time I've spoken to him since he returned, Simon Williams, Chief Economist for the MENA region for HSBC Bank in the region. So welcome all. Simon, I want to come to you first to get some idea as to the economic backdrop here against which we're thinking. There is a perception that the region is a safe haven in a volatile global economy, rates of growth that other parts of the world cannot match. Is this still true? And what are the potential downsides of this scenario? What are the risks for this benign scenario for the region?
Frank, you've known me for a while. You know I'm not a natural optimist, and there are a host of worries that I can share with you, some fears about things that could go wrong. But I've got to say, I look at how the Middle East, the Gulf, is set to perform, and I think relative to its own historical averages of performance, and certainly compared to what I'm expecting elsewhere in the global economy, I think the Gulf is in good shape. You'll see that in the growth numbers, not so much the headline growth numbers, which will get taken lower by contraction in the oil sector, but for the non-oil economy, which is what really matters in terms of generating prosperity and income and jobs. That non-oil economy came into this year with momentum. And I think it continues. Consumption looks good. Demographic growth looks pretty strong. Sentiment seems really strong. And if you want to know just how much better confidence is here than elsewhere, well, if you spend any time in Europe over Christmas, you'll know how much cheerier the outlook here is. I think that feeds through into decent levels of consumption growth across most of the region over the course of this year. I think investment growth picks up. And again, there's a real contrast with other parts of the world elsewhere. Access to capital is so difficult, capital is so expensive. It's hard to see much of a pickup in capital formation, but because the Gulf is drawing its own resources and because those capital spending plans are so well developed, I think you will see investment spending pick up over the course of 2024 off the back of what was a pretty strong 2023. My big surprise last year in terms of non-oil performance was how well travel and tourism did. I think there will be some headwinds that come from that, particularly from the weakness of the outlook in Europe, but I'm still looking for a pickup in demand to take advantage of the big increases in capacity that have been in that service, export-orientated service sector across much of the Gulf. So there's some cyclical momentum, which I think runs. There's also cyclical protection, these big buffers, strong balance sheets, low levels of debt, high levels of savings and other reserves, which allow the region, I think, to cope with any macro shocks or even political shocks that may come its way. And then alongside that, there's a movement on structural reform. I'm not seeing it everywhere, and there are some parts of the Gulf that are lagging, but certainly in Saudi Arabia and the UAE, the structural reforms have already been rolled out, and I think the likelihood of more adjustment coming over the course of this year is lifting the potential growth rates, helping to solidify the macro cycle, and again feeding through into a regional story which is significantly better, significantly more resilient than elsewhere. Yeah, the oil price is a worry, and the geopolitics are a worry. I do have concerns that for parts of the Gulf that aren't moving ahead on structural reform, the cycle has already matured and may start to dip. But for those two biggest parts of the region, last year was was good. I think this year looks pretty good too.
Simon, let me ask you specifically and briefly, if you would, about Saudi Arabia, because it is currently in recession, I believe. When do you see it pulling out of recession?
Yeah, Frank, you need to differentiate between those headline growth numbers and the non-oil growth numbers. The oil sector is contracting because oil production is being marked down in line with the broader OPEC agreement. So you will see overall exports fall, just as you'll see energy industrial production contract year on year as well. What really matters is the feed through from that oil sector into the non-oil sector. Provided oil prices continue to hold at around this kind of level, I think the non-oil economy is pretty well protected from that drop off in oil output.
Okay, thank you. Robin, within this kind of benign economic scenario, how are the NOCs, the national oil companies of the region behaving? I described them earlier as being self-confident and expansionist. But has there been a conscious decision on their part, do you think, to go out and make their mark in the world? Are they taking up the space in some way that the independent oil companies are vacating?
I think they're taking quite different approaches, Frank. And if you look at the different Gulf national oil companies, and the strategy, it's really pretty interesting to see the differences in emphasis on their strategies. I mean, if we take, I'll start with Qatar, for example. I think it's quite a different one. Obviously, extremely strong in LNG, expanding their LNG capacity and making investments in that regard, but also doing a lot in the international upstream. So they're in places like Guyana, they're in Namibia, they're in the Eastern Mediterranean, and they've been perhaps the most active in recent years about going out and had a lot of success in the global exploration domain. So that's to me is a pretty interesting one, because they are very much turning up in frontier exploration areas where, as you say, the traditional independents have increasingly the past years withdrawn or struggled and not been able to raise capital for those kind of ventures. We haven't seen much in the international upstream from the other Gulf NOCs, but maybe we're now starting to see that from ADNOC. ADNOC, of course, trying to do a deal again to get into the Eastern Mediterranean. That's kind of held up by various regulatory and now obviously some obvious political issues. Looking at a deal in Libya, for example, on gas development. So we're seeing ADNOC maybe now also stepping out into the international upstream. If we look at Aramco, it's a different story. Aramco has done a deal in LNG, kind of indirect deal, but Aramco much more focused on the downstream and doing deals in petrochemicals and refining, particularly in China, where there's been several mega deals, and ADNOC also kind of following that approach as well. So a bit of some differences in emphasis. I don't think we're yet seeing them anywhere near kind of replacing the either the IOCs or independent international oil companies. The scale of what they've done so far is still much smaller, but I think there is a very interesting question there. Yeah, in a world that is really constrained on upstream spending, particularly upstream spending outside North America, will you see more Gulf companies active in that space and picking up opportunities and acquiring assets from the majors, particularly the European majors, as they try and pursue some lower carbon strategies?
Robin, I must ask you, one of my wacky New Year predictions was that a regional NOC would buy a US shale company. Tell me how wrong I am.
We've talked about this, on and off for years, I guess, Frank. And I've felt, there's some reasons why that might not be a bad idea. And I think for me, one of the good reasons that was understand your enemy. We've seen yet again last year, in the second half of last year, we thought shale was really coming to the end of its growth phase, and it's actually had a very, very strong year, and that's put a big pressure on OPEC. And this kind of repeated struggle to understand what shale can do has definitely been a problem for the Gulf. So regardless of just the merits of the investment itself, understanding that industry is helpful, and getting access to some technologies that could come back here. Both Aramco and ADNOC have shale gas development ambitions and projects as well. I think that for me the space is really there in the international arena, where if you look at Africa, for example, a lot of good assets there. A real struggle for particularly European IOCs to invest. The Americans are not interested in general. So there's kind of an open field there for anybody else who has capital and still likes the upstream hydrocarbon industry.
I don't think the American regulators would like it very much, though, would they? But Kieran, let me move to you, because one area where local energy companies are making a big splash is in trading, which of course is your domain. We've seen both ADNOC and Aramco beefing up their trading arms, competing with the likes of Vitol and the trading operations of the big investment banks, indeed. So how are you shaping up to face this new competition from oil companies, essentially?
Yes, good morning, Frank. Well, their sort of foray into the trading space has evolved over years. They've all of the national oil companies in this region have sort of had long-held ambition to trade more of the value chain. So they've in various sort of levels of depth, they've engaged with us through the years. In fact, one of the early movers in that space was Oman Oil, which became OTI and is now OQ, and we were a partner of theirs for 10 years as they evolved through trading to what they are now. We each year it evolves, as I say. They graduated on from products to ADNOC through their CFP project, now looking to crude and to further open up IFAD. With regards Aramco, they're sort of widening their geographical footprint and have done that a few years ago through the acquisition of Motiva, and that gives them access to some of the US markets. So I think this we haven't gone into 2024 and this is a new phenomenon. They've graduated their sort of risk appetite and geographical footprint through the years, so it's natural competition. And as I said, in some geographies we have worked together as partners as well. It will be interesting. Through the years they've particularly ADNOC and Aramco, they've shown some appetite to grow in Africa, for example, through government to government contracts. We've seen Aramco making some downstream investments to place their products more recently, and they bought 40% stake in gas and oil in Pakistan, which gives them a mogas and diesel short into that country. So as I said, we've it's not a new phenomenon, but it continues to grow. Their footprint continues to widen, so it's natural, healthy competition.
Okay, and there's plenty of business to go round, I guess, even more so in an energy world affected by sanctions against Russia. Has that increased business?
Say it's increased business. It's not material impacted demand. There's been geographical dislocations because of flows, and a lot of companies have had to deal with that. But that's largely, I guess, since the 5th of February last year. The market has matured in regards to handling those dislocations, and I don't see any big change in that regard going into the new year. Right.
Thanks, Peter. Dan and Abby, OMV is a long-standing partner of ADNOC. Talk me through the OMV strategy, if you would. I'm not asking you to speak on behalf of Dr. Sultan Al Jaber, but also if you could give some idea of how you see the ADNOC strategy here. And will they keep on swallowing up parts of the global value chain?
Yeah, thanks for the question, Frank, and thanks for the opportunity to talk a little bit about our strategy here. As you know, I'm an upstream person, so I'm in the classical business here, and we are partnering with ADNOC here to develop and to produce offshore oil fields, quite successful, I might say. And I'm really proud to see that part of the strategy that had been announced by OMV is now resurfacing, not on a much bigger scale than we have seen, but going in the same direction. And at the end, it's all the push for a net zero. Now, in OMV's case, it's net zero by 2050. In ADNOC's case, it's announced net zero by 2045. However, there are major differences because we are clearly specifying scope 1, 2, and 3. So we're also specifying the majority of our products, the CO2 content of our products to be abated or net zeroed out. And for that, of course, then we would need to change our portfolio. That is more difficult, I think, for the NOCs. So our portfolio will grow more into gas. We will have a decline in our oil production until 2030. Of course, all the companies already have committed to more or less completely eradicate flaring and venting and reduce the methane intensity by 2030. But I think the net zero goal requires some building of the low carbon business that we're doing as well. And in our case, OMV announced 5 billion until 2030. ADNOC, and ADNOC is much bigger than OMV, has announced 15 billion. In comparison, OMV has announced 5 million tons CCS capacity by 2030. ADNOC has first started with 5 billion. I predicted this will not be the end. Now it's 10 million tons, 10 million tons per year. I also think this is not the end, but it's a starter, because CCS, as well as other low carbon business possibilities, geothermal, for example, are the only way to offset your carbon footprint. In ADNOC's way, I said they have announced 2045, and it's scope 1 and 2 as far as I understand it. So electrification of the offshore facilities, that's already on the cards, but also additional business, and they already announced some direct capture, but also big CCS projects. And recently you have seen that the FID of Ghasha, which has a part of a sort of supporting the net zero ambition of the country. And I think this is more or less the push that everybody sees. Every oil company know in the end there is a decline in oil demand, but still on a high level. We are talking about 104 million barrels this year. We are talking about 110, 115 million barrels according to OPEC in 2030. That's still a growth. And we need to ensure affordability of our product. And we need to assure at the same time the lowest carbon footprint. And this, in order to quote Dr. Sultan Al Jaber, more energy with less emissions. I think this is the global outlook for everyone. Where do we go as company, as NOCs? Where do the international companies go? That's a different topic, and I think this will be the second question that we can.
Yeah. We will talk about energy transition, but towards the end. But specifically, Abu Dhabi are obviously committed to net zero. Are they also going international on this? Are they expanding, and partnering with other countries in the energy transition phase as well?
Yeah, we see that already. Some announcements recently have been made, and you can see that on the press. And I think that's an absolute vital step. I mean, CCS can be done in Abu Dhabi, can be done in the UAE. Geothermal is a different topic. We have seen already many announcements by Mazda on sustainable fuels as well. I think this is a big topic here. But technology is I think the driver for growth in that area going internationally, because you need not only to apply technology from third parties here, you need to tap into the source. And I think this is a big push for swallowing up or participating in technology companies worldwide.
Okay. You will see a poll question has flashed up. If you could just take a moment to respond to this. Gulf Arab economies and industries' momentum to compete globally is likely to slow down in 2024 due to lower oil revenues. We've had some view on that already, but if the audience and the room could give their verdict, please, on that one. And then I want to go back into trading, if you don't mind. Sorry, just let me cast my vote. I want to stay with the traders, really, because we've seen some big moves in the logistics of the global oil trade recently. I'm thinking of the big increases in refining that we've seen in the region, and indeed the world's largest underground oil storage facility due to open next year in Fujairah. Kieran, how will these moves and others like them affect the dynamics of global oil trading in your view?
Yeah, it's going to be an interesting year in that regard, Frank, because largely through 2023, we did see the new Middle East refining capacity come online, but this is really the year that it needs to stabilize. That there was, particularly if you look at Q4 there were large disruptions in the refining sector around the Middle East. We see probably an increase in refining runs this year. Refinery runs are around 1.2 million barrels a day. A lot of that comes from Dangote refinery in West Africa, and which is undergoing a startup phase of sorts in the next few weeks. So a lot of eyes from the energy market will be looking at that. But with regards to the Middle East, between Al Zour, Duqm, Karbala in the AG, and Jizan over on the Red Sea, we still see room for stabilization and an increase in rates and run rates. So with that, there's obviously more product to market, and as our outlook for 2024 is that largely, should that sort of 1.2 million barrels come online, that effectively equates to the product growth that we see across the year. So again, there'll be some geographical dislocations and some there'll be a mixing of yields needed, but largely the big growth we see is probably still in the aviation sector, and so we still see room for jet demand growth, and of course the refinery sector in the Middle East is middle distillate heavy and can cater towards that demand on the gas oil and jet fuel side. So I think we're well equipped to meet what is pretty average demand growth, but
right.
The refinery sector is there to meet it.
In kind of general terms, Kieran, how does the region now rank in comparison with, for example, Singapore? As a trading and refining hub. Yeah, sorry.
Yeah, that's grown. We spoke through the year in some of the GI forums. It really has evolved into a market in of itself. The sort of Middle East, if you take West Coast India, Middle East, and East Africa, it really has evolved, and hence there's been an attraction towards Dubai, Abu Dhabi, Bahrain for trading companies over the last couple of years post-COVID, because of the liquidity around the market, because of increased refinery capacity, and of course there's a scope for more crude exports. And as you alluded to there, Fujairah is developing itself to be a monstrous storage hub, and now with huge underground crude storage to come online as well.
Right. Robin, let me ask you about production capacity, because there is big potential, isn't there, for both the UAE and Saudi Arabia to dramatically increase production in coming years. KSA say that they want to go to 30 million barrels at some stage, UAE to more than 5 million, I believe, is it, or 6? From roughly three and a bit where they are now. Without getting caught up in the OPEC rabbit hole, what's stopping them from doing that?
Well, and the UAE's capacity actually, well over 4 million now, and targeting 5 million by 2027. Now they brought that target forward, and even with a possibility or a conceptual thought of going to 6. So a very major production increase, or production capacity increase, and Aramco, as you say, adding about 1 million barrels per day over the next few years. I mean, there's really nothing stopping them other than OPEC, simple as that, and their views of what the market needs and how much they want to put on the market, and conversely what the price will be. Technically, ADNOC particularly is sitting on a huge amount of spare capacity today, and to proportionally to a lesser extent, but Aramco is as well. Technically that these projects are well advanced, and that production capacity is sitting there waiting to be used, and I think the again, as you say, without going down the rabbit hole, but as we know, the UAE in particular has been pushing to try and use more of its capacity.
What are the circumstances that prompt them to use that capacity to actually implement it?
Well, I think there's the short term aspect is just simply where is the market? Do they see the market needs that much oil, and how are prices looking? And the prices at the moment are looking a bit weak, not terrible, but not to the stage that you'd expect OPEC to be making any major production increases. Maybe second half of this year, maybe, but even that's kind of questionable. So it doesn't look like this year is going to be great for making any progress on using that spare capacity. I mean, unless there's a major disruption somewhere, obviously, but on a kind of business as usual. No, I think we're looking at a few years before whether either Aramco or ADNOC's capacity utilization starts going up significantly. Obviously, there's a longer term strategic aspect to this. If you're in a world in which there is decarbonization and an overall drop in oil demand, but maybe your competitors are investing less than you are, you have a chance to gain market share in the medium term.
Yeah. Simon, this underutilization of capacity is actually robbing regional economies of revenue. What do they do about this? We've already seen some strains in Saudi Arabia with possible delays to Vision 2030 mega projects. How can they pay for these when they're not selling as much oil as they can? Deficit funding, is this the future? They've always tried to avoid it in the past. What's the outlook for them for their creditworthiness if they do want to go deficit funding? Talk us through the financial aspects of this, if you could.
Well, I think there's a few observations to make. One is that it's not about production; it's about revenue and production, and revenue is production times price. So I care about is the dollars coming in, and you're right, they are going to be a little weaker this year than last year in all likelihood because of the drop in production. But if you look at that revenue stream against on a 5-year, 10-year average, those revenue numbers still look pretty good. So this is by no means a bad year for oil receipts. You're right. Some of the countries will be running shortfalls, but what matters to me is the shortfall through the cycle. 1 year's deficit, if it comes after a previous year's surplus, net you're still flat and in a good position. On top of that, you've got governments that have got really strong balance sheets, so they have the capacity to raise funding or draw down on savings to deal with budget shortfalls, fiscal current account shortfalls that may come through to ensure there's sufficient funding available to finance some of the priority capital projects. So I think you need to see it in the context of those balance sheets. I think you also need to recognise, though, there's a difference across the region as to how well they can cope with softer prices and softer production. That for somewhere like Saudi with low public debt, the challenges are reasonably easy to manage. The big bond issuance that we've already seen this year gives you a sense of the ease with which they can currently raise financing. But for other economies where it's a bit more stretched, most obviously Bahrain, that lower revenue base is already taking a bit of a toll on public finances and on the external account as well. So I guess think about it in terms of revenue, not just in terms of production. See it through the cycle, not just one given year, and read those numbers in the context of their capacity to access the funding that they need to maintain macro stability and pursue their growth objectives.
Right, but the global creditworthiness of Saudi Arabia and the UAE is pretty good, is it? They can go to international capital markets to make up deficits.
Well, they have multiple options for financing. They've got global markets to draw from, domestic markets to draw from, and there are also some pretty big stocks of savings that they can draw down as well to ensure the deficit is covered. But specifically on your question about their credit worthiness in global markets, yes, it's very, very strong indeed. Even looking at shortfalls, Saudi Arabia's got a debt stock under 30% of GDP. That's low by any standards, even before you start to think about what the net debt is when you take away the asset stock from that borrowing number.
Right. Have we got the results of that poll? Can we see that? That would give us some Right. So 60%, you know, quite a majority, see a slowdown this year because of lower oil revenues, although even so, a big minority at 40%. So I want to spend the last part of this session talking about the theme, you know, is about the global impact of local decisions and regional events. And of course, the big regional event of the last year was COP28, huge global repercussions. And I just want to get some sense of what our experts here today think of the outcome. It mentioned for the first time reductions in fossil fuels as a goal. So I guess the question is, as the Guardian newspaper trumpeted on the day that this was the end of the fossil fuel era, I'm wondering what that means for local economies. Kieran, give me your sort of macro thoughts on COP28 and what that means for your industry, for your company.
Yeah, I think there's a general consensus that timeline is key here. You know, there was the timing of the conference effectively coincided with an acceptance that 2023 was probably going to be the warmest on record, and therefore action needed to be taken in that regard. And Dr. Sultan Al Jaber did a tremendous job in you know, both hosting but getting consensus in the last few days to an agreement. But as with all of these COP conferences, it's all about implementation now. And that's what remains to be seen in terms of the countries that have signed up to the agreement, how they go about implementing it. With regards to how does it change the market, if that's what you're alluding to, it's probably not going to have any sort of drastic impact today or tomorrow. You know, each country has set its climate goals and its net zero goals, and you know, they're 2030, 2040, 2050, depending on size and how developed the sort of transitional space has been. So you know, in short, Frank, I don't see an immediate change over the course of this year.
It's unlikely to accelerate, you know, the end of fossil fuels, in your view. Unlikely to accelerate. Right. Peter, you know, you are heavily committed to the energy transition. Were you pleased with the outcome? Do you think that the UAE covered itself in glory? What's your take on COP28?
Yeah, on the second question, whether they covered itself in glory, I think I would say this is a really, really difficult job that they had to do as a major oil producer and exporter to balance the views, and I think they did this really, really well. Because what I'm really pleased about it is that the narrative that you described, end of fossil fuel, is much, much, much too small, and this is a European narrative. If you talk about the global narrative, then it's increasing demand for energy, increasing population growth, and it's about affordability and energy security. And I think these views were balanced. And therefore, you need technology, but you also need a sustainable energy production. And renewables alone might be a good theme for developed countries that can afford it. Look at the subsidies in Germany, for example, for renewable energy that are now currently hitting the budget. But this is not the baseline energy supply that you can rely on in growing countries. India said that very clearly. India really defended their coal production because of the economic growth. Now, I think the problem is not fossil. I mean, I call it rather classic. The problem is CO2. So if we have an issue with CO2, let's tackle CO2. And let's make sure that the world has the energy it needs at affordable prices. And I think that's a takeout that came really strongly out. Unfortunately, the narrative was too much focused to end of fossil era. The end of the oil age will not be because we are running out of oil. It's because of better alternatives. But as long as people need energy, we have to make sure that they get it.
Okay. If the problem is CO2, then the answer is to remove CO2, and that involves CCUS and direct air capture and all the other technologies. But the environmentalists say that these technologies are nowhere near ready to be practical solutions to climate change. What do you think?
I think in CCS, this is not true, because we do gas storage since, I don't know, decades. And CCS is another form of gas storage, if you want, for future use, for example. So I think we are very much advanced, especially Norway and other countries. That Poseidon project, 5 million tons announced in Norway now. So I think this is technology is not the problem. Scalability is an issue. But here we talk about financial muscles, we talk about CO2 pricing. And I think for Europe, it's definitely an alternative. If I look at the CO2 pricing going up drastically, actually, I think this will be a viable business. And I think the UAE got the message here clear, and are trying to become a front runner by announcing and doubling their CCS targets to 10 million tons per year, just recently. So I think scalability, we will see that soon. CCS is a viable support. Energy efficiency, you named it, a reduction in primary energy demand, at least in the developed countries, will happen. And then I think there will be new technologies coming on stream as well. If we talk about pyrolysis, circular economy is a big topic, but all together tackling the net zero that everybody committed to.
Right. Tell me, there is still skepticism in European and North American circles about the commitment of oil and energy companies in this region to fight climate change. They still think that they're trying to spin out the age of fossil fuels. They want to keep on producing for as long as possible and sell as much oil as possible. Let me ask you, Simon, how do you gauge the commitment of regional countries, regional economies, the national energy companies of these countries to combat climate change and energy transition? Are they sincere?
I think they are sincere, and I guess I would argue that there are actually huge economic opportunities that come with this energy transition for the Gulf. It's not being pursued at the same pace everywhere, but I think there's a real capacity for the region to become a leading producer of renewable energy, to use that renewable energy as a basis for an export-orientated green industrial sector that can form a key part of the region's economic diversification story. Again, it's been pursued at different paces in different parts of the region, but certainly here in the UAE, in Saudi, and elsewhere as well. I think that commitment is strong. It's real, and I think there's a motivation that comes from that from very clear economic self-interest, as well as concerns over the global climate.
Right. So the think global, act local formula actually works quite well for regional energy economies, doesn't it? If they apply global lessons here, then that will directly affect the level of emissions and the level of CO2 and global warming, etc. But could also be an example to the world. They keep on saying that they are leaders in the energy transition. The world doesn't believe them. But Robin, what's your take? I read a very good column that you wrote in The National recently, talking about future generations and what they would think about the decisions that we're taking now. Give us your take on COP28 and its long-term implications and its global implications.
Yeah, so I take a few things away from COP28. Look, and I think this question of, is it the end of the fossil fuel era? The decision taken at COP doesn't have a direct impact. Countries will do what they were going to do, whether that's major action as in Europe or less action as in some other places. I think it does have impacts though on how people view long-term strategies, and it does also have legal impacts. We are seeing more and more climate litigation. We're going to see more and more litigants taking up the decisions at COP and using that basis for legal arguments, and that eventually has an impact on, particularly on national level policies. But you know, the transition so far, it's been, as Simon and others have said, it's been driven by economics and the improving performance of low carbon technologies. I mean, that's why people are buying EVs. Yes, there are subsidies in some places, but electric vehicles are just getting better and cheaper, to the point that they're approaching conventional vehicles. Renewables are cheaper than fossil fuels in many applications now. Yeah, not to get to 100% renewables, but to get to 50%, even 80%, with some backup, that is cheaper, and that's why many countries are doing it. And we see that in the UAE, of course, in the Gulf in general, solar power is outstandingly cheap, and that's why it's being built on such a huge scale. So that momentum, I think, is kind of is pretty much unstoppable now. The blockers have kind of gone beyond economics. That there are other things to do with supply chains, international geopolitics, to do with the practicalities of building out these systems on a huge scale very quickly. That's really the challenges now, I think, and that comes down a lot more to national level policies than to what's happening internationally. But when we get to this question of, you know, okay, well, as you say, the long-term view, what I was trying to argue in my column is, okay, 2050, that's not very far away. You know, that is 26 years away. That is basically, you know, my career in the energy industry is now more than 26 years. So I'm like, wow, that's so we're talking about the rest of my career gets us 2050, and we're meant to be net zero by then. That is a colossal challenge. And when you look at the time scale for a major project, a major oil and gas project, a CCS project, a nuclear project, you know, 10-year development time scale. So you can do, you know, 2 of those, 2.5 by 2050, and you've got to be at net zero. So my point really, 2050 is not the end of time. You know, our children and our grandchildren are going to be alive, hopefully in 2100, and, you know, even beyond that. And you know, who knows what the global energy economy will look like by then. But there's a lot of work to be done post 2050, and we need to at least think that whatever we do now, it's very uncertain what happens post 2050. But we need at least to make sure that our world post 2050 has options. We don't close things down. We create options with new technologies, with new policies, and hopefully not leaving a legacy of disastrous climate change that's very hard to recover from.
Right.
Sorry to interrupt.
Well, fantastic
Frank.
to end on that on that note. So I think it's time we have to close. So let me thank Peter Zeilinger, Kieran Gallagher, Robin Mills, and Simon Williams. I think that was a very interesting session. Thank you all very much, and I look forward to hearing the rest of the day. Thank you. Goodbye.